As with the U.S. stock market, the U.S. bond market surged on news of Donald Trump's presidential win. When bond prices rise, the yields or the interest rates they attract come down. Conversely, when bond prices decline, the interest rate rises. Investor confidence will likely be positive for bond prices, but Donald Trump's presidency comes with a lot of fiscal risks, which could adversely affect the bond market. Well, to unpack the issues for us, I'm joined by Attila Kadikoy. He's managing partner at Levantine Co. Thank you so much for joining us, sir. So the market euphoria over the Trump win has happened, and it seems that market participants are now in a wait-and-see pattern. So tell us what your observations have been of the U.S. bond market from the time of the realization that Donald Trump is set to become the 47th president of the United States to what you're seeing now over a week later.
So you're very right, there was a euphoria building possibly before the election, and we saw post-election, especially on the crypto side and on the equity market, there was a huge rally that we've been seeing. The fixed income side, somehow people have been, I think, ignoring almost. And we've seen a significant trend creeping up of interest rates. So currently, if you look at the US 10-year, now what's important about the US 10-year bond, this is like the benchmark globally, we could say almost, for the risk-free rate, that all interest rates are based on, we could almost say. And the 10-year has creeped back almost to 4.5%. Now, what's important about this is we saw it come down to almost 3.6% following the Fed's rate reduction in rates and a more kind of disinflationary outlook in markets. And therefore, I can say the fixed income market is definitely pricing more risk at the moment.
So what are the implications of Donald Trump's plans to cut taxes when he comes into office? Because presumably that will mean that the U.S. has less revenue. And of course, it still, it puts the fiscus under pressure because there's still the important economic imperatives that the government still needs to pay for. So what then are the implications?
Actually, the tax reduction is only one of the issues. So you're right. They have spoken about bringing down corporate tax rates from 21% to 15%. And that's, of course, going to be a reduction in the government's income. Now, there's also certain inflationary pressures that he's talked about. Well, not as inflation, but, for example, deporting immigrants. Now, there's up to 11 million immigrants in the U.S., and they make up a large part of the income pool at the moment. I mean, the U.S. economy is doing well, and a lot of the, let's say, lower income or lower paid jobs, construction jobs, etc., is a fair portion of unregistered immigrants there. On the other hand, as you know, he's talking about pushing tariffs up. Now, 10%, I think, on imports and up to 60% on Chinese imports. This isn't necessarily going to have a positive impact on government revenues. We can unpack that, but definitely there's a gap and the markets are worried.
So we remember the Liz Truss premiership in the United Kingdom in 2022, where she also made all sorts of promises in terms of tax cuts. And indeed, that was done, but it was very temporary as bond investors punished UK capital assets by selling off UK bonds, which had an adverse impact on the British pound. If Trump does get it wrong, which you seem to be quite concerned about all of these factors playing together, could we see a similar situation arising?
So, yes, I'm watching closely. I'm not making any assumptions, and it's too early to say how things are playing out. But it's definitely one has to keep a close eye. And it's wrong to, like some investors, say this is what happened between 2016 and 2020, so we're going to see a similar thing. Now, the Liz Truss moment is something that's mentioned. My only pushback on that is the dollar is a very different animal to the US pound. The US pound is not necessarily an international currency. There is oil is priced, for example, in US dollars. So there's a lot of transactions. In fact, There's more USD transactions outside of the US than necessarily in the US. So the dollar is a different animal. But when you come to US debt, it is definitely being spoken about more. And there is a possibility that rather than Trump dictating market direction, there could be a point where the markets dictate the political direction in the US, like the Liz Truss moment.
And then coming to South Africa, you know, if the inflation story does take off next year, what are the implications for South Africa? It seems like an obvious question, but what does it mean for ordinary South Africans? And how should people then position their investments? So those are two different questions, but very briefly in a minute, can you answer the two?
So inflation also is linked to growth and how fast the growth is in the country. The rand is a relatively stable currency when it comes to emerging markets, and therefore, it's not a dollarized economy in South Africa, unless we see a significant uptick in growth. I think what would happen is the imported goods. You would see maybe a price increase in imported goods. At the end of the day, there is something called global inflation, and we could have an impact on that. When it comes to investing, as we do, I mean, we highly recommend highly diversified portfolios, looking for a long-term sustained growth rather than chasing the AI story or emerging market story or now the Trump crypto story. So one has to diversify. And I think in that diversified portfolio, US equities could have a less position than they did prior to the election.
All right, Attila, thank you very much for your insights there. That was Attila Kadikoy. He's the managing partner at Levantine Company.